This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 4 videos on trading tight bull channels. Whenever the market is in any kind of a strong trend, a tight channel, or a breakout, for example, the first reversal is usually minor. In other words, it usually is a pause in the trend and the trend resumes. Whenever a bull channel is tight, traders should only be looking to buy. If you look at the next higher time frame, that tight bull channel is a breakout, and you should not be looking to sell if the market is in a strong breakout on the very next higher time frame. This is a 5-minute chart of the euro versus the dollar, and you can see that the market is in a bull trend, and the pullbacks are all brief, just a few bars, and not falling very far, 5 or 10 pips. That is a tight bull channel. Even if a trader bought the absolute worst price on the chart, this highest close, he would be able to avoid a loss if he managed his trade correctly. Let's say he buys that bar and puts the appropriate stop below the most recent major high or low. We have a strong breakout to a new high. There's a problem with buying this close. It's the biggest bull bar in about 20 bars, and therefore there's a risk that it's a climactic end of the trend. In addition, we have a high to bull flag late in a bull trend after 20 or more bars. It usually ends up as the final bull flag. This is about 50 bars into the trend, so it's risky to buy up there. But even if you did buy, because the channel is so tight, the market will probably allow you to get out without a loss. Usually, a tight channel has to become a trading range before it can become a bear trend. And that means that the bulls have time to exit. Very little chance of their stop being hit without opportunities to get out with a smaller loss or no loss earlier on. We have a bull trend line here, a little break below. Immediately after buying this close, the bulls were disappointed by the bear bar that followed, and then they have another bear bar closing on its low. My general rule is if the market has 3 consecutive bear bars, then there's an increased chance of at least a second leg down. And this is especially true if the market is having a buy climax. A very tight bull channel is a buy climax, especially late in a bull trend. And we have a potential final flag here. And therefore, there's an increased risk of a trading range. And the trading range might be all the way down to the bottom of the final leg up in the bull trend. This is a buy climax. If you look at a higher time frame chart, you'd see that it's 2 or 3 consecutive bull bars closing on their highs, and therefore its low is a magnet. As long as the bulls can keep making major higher lows, like here, 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 it's in a bull trend. As soon as it falls below a major higher low, then it's no longer in a bull trend. It's either in a trading range or a bear trend. In this case, it was a bear trend. In any case, if I see 3 consecutive bear bars, here we have 4 consecutive bear bars after a buy climax and a potential final flag, 20 or more bars into a bull trend. This is 60 or 70 bars into the trend, and therefore increased risk of exhaustion. As soon as I see 3 bear bars, I'm sufficiently disappointed that I'm no longer going to treat this like a strong bull trend. I'm going to start treating it like a trading range, and the bottom of the range is probably going to be down near the bottom of this strong buy climax. And that means if I bought here by the second or third or fourth bear bar, I'm thinking we're probably going to trade down to here and form a trading range. I don't want to be buying here in a trading range. I don't want to buy high in a trading range. I want to buy low in a trading range. I want to sell high in a trading range. I can sell to go short, or I can sell to get out of longs. Once we get that third bar, I would be sufficiently disappointed that I'm either going to sell out with a loss on the close of the third bar, sell out with a loss at the high of any bar, the prior bar, and get filled here, or hold and try to get out break even at my original entry, place a limit order to get out at my original entry, or a pip or 2 below. And you can see this tail right here. That was caused by a lot of bulls who were so disappointed by the 4 bear bars that they were eager to get out break even on their first entry. And then we had another 5 bars down. You can say, well, You said 2 legs down, 1 pullback 2. Can't the bull trend resume at this point? After 5 consecutive bear bars with 4 bear bars here and a big magnet here at the bottom of the most recent major leg up, the odds are we're going to go lower, and therefore the bulls will not buy this even though it's 2 legs down and a bull trend, 1 pullback 2. We're probably going down here. This is really not a major trend reversal. You can say, well, Al, didn't we go up, break below the trend line, and then get a higher high major trend reversal? There's really not that much selling pressure here, a pretty tight range, and it barely broke below the bull trend line. Not enough selling pressure. And then you've had a lot of buying pressure since then, and therefore I would not view this as a higher high major trend reversal. And I would really not view it as a final flag reversal. I would view it more as an exhausted bull trend. And then we have a small double top, break below the neckline for a measured move down, and then I expect an evolution into a trading range. I see this as a minor reversal, even though it has 4 bear bars. That means the odds are it's probably going to be a trading range. Even though we sold off for about 30 bars here and retraced more than half of the rally and fell below this low, I still think this sell-off is probably a bear leg in a trading range. I don't show the bars to the right, but I bet the odds are that we bounced and then we have big up, big down, and then big up again, and then we converted from a bull trend into a trading range. Whenever there is a reversal in a very tight bull trend, 70% chance the reversal will be minor. 30% chance you'll get a bear trend. Here, we got a bear trend. But as I said, if you get out on that close, on this close, above this high, or break even, or on a third or fourth close down here, you lost about 10 pips. Not very much. You don't let your stop get hit once you decide your premise has changed. And once you see 3 bear bars, 4 bear bars, and then again 3 or 4 or 5 bear bars, you can no longer look at this as a strong bull channel, and therefore your premise has changed, and therefore you cannot use that stop. The bulls who bought this close expected a minor reversal into a bull flag and then for the bull trend to resume. However, after they see 3 or 4 bear bars with 3 closing below their midpoint near the low of the bar, they know the odds are we're going to go a second leg lower. And therefore, if you bought this close, you're not going to be eager to buy more lower. You're not going to place a limit order to buy 10 pips down. You'll wait to see what the sell-off looks like, and if you get a strong bull bar, you might buy above the high of the bull bar to add to your position. So for example, you buy that close, maybe buy here, I would not, this channel is too tight. Maybe buy here, 3 pushes down, 1, pullback, 2, pullback, 3. I would not, even though it's at support, the bottom of the buy climax. The channel is too tight. I would need the market to go sideways more and to form more bull bars. So had I bought this close and I saw these bear bars and these bear bars, I would get out and take the 10 pip loss. I would not be looking to scale in lower, either 10 pips down or above a bull bar here or here. A lot of the bulls were so disappointed by this 4-bar sell-off, they just want to get out, break even, or with a small loss. They expect a second leg down, and they do not want to buy more unless they see a strong upside breakout or a clear bull flag. The market's starting to go sideways and starting to form bull bars, which it did not do enough of here or here. Not enough big bull bars. Too many consecutive bear bars closing on or near their lows. As I said, a lot of the bulls, if they did not get out on the 3rd or 4th bar, they'll place a limit order to get out break even at their original entry, and this bar allowed them to do that. And that's why we have that tail there. This bar briefly was a bull bar on its high, but by the end of the bar, instead of bulls buying, bulls were selling. The bulls who bought this close were happy to get out without a loss, so they sold. And the bears knew these bulls were trapped and would be eager to get out if the market got back to their entry price, and the bears therefore sold there as well. Every bull trend bar is a buy climax. Every series of bull trend bars is a buy climax. We have a buy climax, another one here, 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 and then here. This is a series of buy climaxes, consecutive buy climaxes, and that usually evolves into a trading range. The market gets exhausted, and a minimum goal would be 10 bars and 2 legs down, which we got at this point, but the bear channel is too tight and not enough in terms of good-looking bull bars, and therefore we're probably going to go more than 10 bars and 2 legs down. We're very close to the magnet of the bottom of the final buy climax, so we're probably going down to that low. Therefore, traders will not buy here when they believe it's going to get down here. Five consecutive bear bars closing on their lows. The market's clearly always in short, and that means it's probably going lower. It may simply form a double bottom with this major higher low and resume up, but at this point, the market's clearly always in short, and traders should only be short or flat. They should be out of their longs. Had you bought here and did not take the opportunities to get out here or break even here, you have to get out here and take your 10 or 15 pips loss at that point. I said here, after these 4 bear bars, the odds were that was enough selling to get a second leg down. And now we have 5 consecutive bear bars, and that's even stronger, so we'll probably get a second leg down from here. So 1 pullback, maybe 2, maybe 2. And we also have a magnet of the bottom of the final buy climax, so we should get down there as well. And therefore, there'll be sellers above the high of the prior bar, so traders will sell with a limit order at the high of the prior bar. As soon as this bar closes, they place a limit order to sell at its high. This bar does not get above that high. As soon as this bar closes, they place a limit order to sell at its high, and they get filled right there. Stop up here. Bears will sell above bars, so they'll sell with a limit order at the high of this bear bar, and they get filled right here. And they'll also sell below a bear bar if they expect a second leg down. So other bears will sell below this bar and they get filled right here. Selling with the limit order at this high, selling with a stop order 1 pip below that bear bar right there. Bears starting to sell closes. It's a sell the close bear trend. Bears do not sell every one of these closes, but they'll sell any one of these closes. Some bears, if they take a small initial position, they might sell more on the second bar and the third bar. Bigger bear bars, strong breakout. Tails, not great follow through, but the bars all have bear bodies, and there's room to the bottom of this buy climax. Even though this is not a big top, it's only 4 bars down, 3 bars up, and therefore probably going to lead to a minor reversal. In this case, it led to a major reversal, 30 bars down in our tight bear channel. This is a sign that the final bulls are giving up. Some bulls who bought here, or who bought for any reason, expected 2 legs down, 1 pullback 2, and therefore they thought the bull trend would resume. And they have a first entry buy, not good, bear body, and now they have a second entry buy and an outside up bull bar. So some bought here, but as soon as it fell below this bar, the remaining bulls gave up. And this pair of bull bars with decent sized bodies represents the bulls giving up. They're just deciding that it's not going up, it's probably going lower, and they were just going to get out and take their loss. We have a strong bull breakout and follow through. There's a big breakout bar, and the following bar has a bull body as well. The odds are the market's going to rally for some kind of a measured move, sometimes based on the open of the first bar to the close of the final bar of the breakout, which would take us somewhere up here. Some traders would buy the close of the breakout bar. Other traders would rather wait to see if the next bar also has a bull body. Even if the bull body is small, they'll still buy the close. When I say buy the close, what I mean is as soon as the bar closes, they hit buy the market, or right before, maybe a second before the bar closes, they hit buy the market. Some traders will place a limit order. As soon as the bar closes, they'll place a limit order to buy at that price, and then they get filled on the next bar. Sometimes it doesn't fall 1 pip below the close of this bar, and in which case those bulls would not get filled. That's why it's usually better just to buy at the market. So when you hear me talk about buy at the close, I'm really saying just buy at the market, just before or just as soon as the bar closes. Because the odds are high, 60% or more, we're going up for some kind of a measured move, traders can also buy below a bar, betting that a reversal down will fail. And you can also buy a strong bear close, betting that it will fail as well and become a bull flag. We have a strong bear close here. We have a second one here. And instead of going down, we're reversing up. The bears are giving up. The odds are we're going higher. You can also buy with a stop above the high of the prior bar. So for example, once this bar closed, you have a small double bottom. Some traders will place a stop order just above its high, and they'll get filled right here. It doesn't matter where you bought. If you bought at the market as this bar was forming, if you took any of these buys, the stop is the same. It's below the bottom of the most recent strong bull breakout. As soon as you think the market is going higher, as soon as you believe the market's always in long and it's going higher, you have to buy at least a small position. Sometimes you have to buy a very small position. Some traders, once they see the breakout, they say, oh my gosh, it's going up, but I don't want to risk that much. One of the advantages of Forex trading is you can trade a very small position and at least get something on. After a rally of 50 pips or so, even a small position generates a pretty good profit. And if you did take the small position, you can also add to it as the market's going up. A buy the close rally, a wedge bull flag, 3 pushes down, 1 pullback, 2 pullback, 3. We have a breakout. As soon as you have a bar going below the low of the prior bar, you have a pullback. Once there's a pullback after a breakout, the market has evolved into the channel phase, which means you can expect other pullbacks. All of them were small. They were all brief, 1 bar, 2 bars. It fell here a little bit, but not even 10 pips, maybe 10 pips. Small pullback bull trend. Strong enough breakout, bull bar follow through. Likely that we're going to get at least 1 more leg up. 60% chance we'll get a measured move up based upon maybe the height of the bull breakout here. You can trade it like a breakout. You can buy for any reason. You can buy just above the previous high. You can buy a strong bull close. You can buy above the high of the prior bar, betting that we have a bull flag. I made the point that if you have a very tight bull channel, it's a breakout on a higher time frame chart. And if ever you have a bull breakout, you should only be looking to buy. And therefore, if you have a tight bull channel, you should treat it like a breakout and only look to buy. I'm always looking at a bull channel from the perspective of the bears. Can the bears make money? If the bears sell at a prior high and scale in higher, can they make money? And that means the market has to pull back below the breakout point. So for example, if a bear sold at this high, he would get filled here. Did the market fall far enough for him to make a scalp? No, right? The minimum scalp size in the Forex market is 10 pips, and this low is not 10 pips below that high. So if you sold at this high and you're a limit order bear, you gave up over here. If pullbacks like this fall below breakout points here and here, then it's a stairs pattern, and bear scalpers will consider buying. However, I don't like to take a sell in a bull trend until I see that the bears have been making money fairly easily. When the pullbacks are small and brief like this, the bears are not making money, or if they do happen to make money, it's very difficult to make money. And when that's the case, it's a clear sign that the market's in a tight bull trend, and it's better to only buy. We have a breakout point, the top of the bull breakout, and then this bar went slightly above its high, and the pullback after that breakout above this high fell below the breakout point, and therefore this is a stairs pattern. And whenever the bears see stairs patterns, whenever they see pullbacks below breakout points, they start making a decision. Are the pullbacks deep enough so that they can make money selling at the prior high, selling more higher? And if they're not, the bears will not sell. And that's the case here. We're pulling back below breakout points, but the pullbacks are not big enough for the bears to make 10 pips profit, a minimum scalp, and therefore very few traders are willing to sell. Bull trends are always forming wedge tops. Bear trends are always forming wedge bottoms. A wedge top in a bull trend is usually going to fail to reverse the market, and the market is going to go higher. A wedge is a channel. It's a bull channel. Whenever it's very tight and the pullbacks are very small, any reversal is minor, and therefore the reversal attempt will probably fail and will probably rally at a minimum for a measured move up based upon the height of the wedge. The bottom of the wedge, top of the wedge, measured move up would be somewhere around here. As I said, some bears, when they start to see pullbacks, will take a chance that the market will have deeper pullbacks or a trading range, and they can make money selling at prior highs. Therefore, some will sell at the prior high, like here. They would get filled here, and then they'd look to sell more 10 pips higher. This did not go 10 pips higher, so they were unable to scale in, and therefore, when the market went down and started to go back up, they were unable to make a profit. In fact, they probably lost money. The limit order bears had limit orders to sell at this high. They got filled right here. They tried to sell more 10 pips higher. It had to go 11 pips above this bar for them to get filled. If you place a limit order to sell, the market has to go 1 pip above your limit order. Therefore, if they sold here and sold more 10 pips higher, they would not have been filled. It did not go 11 pips above the original entry price, which is at this high right here. And the bears gave up on this reversal up. Bear scalpers, they like to sell at the prior high and scale in higher. However, I strongly recommend against doing that unless you look to the left and see that it's been a profitable strategy in the past 10 or 20 bars. If the bears have been unable to make money doing that, you should not be doing that. So do not sell in a strong bull channel. Again, bear scalpers will place limit orders. As soon as there's a pullback, they'll place a limit order to sell at the prior high. And they would get filled here, and they would look to sell more 10 pips higher, and then try to get out break even on their first entry, and then with 10 pips profit on their higher entry. Would I take that trade? No, because limit order bears did not make money selling above this bar, above that bar, or above this bar. I don't want to be the first bear to make money. I want to see bears making money before I'm willing to sell. And the bears are not making money, and therefore I would not take that short. Some of the bears who sold at this high placed a limit order to sell more 10 pips higher up here, but the rally went up 10 pips above this high. It had to go up 11 pips for them to get filled, and therefore the bears who sold at this high got filled here, were unable to sell more here. They got 2 legs down and they panicked out. They tried to get out break even when it came back to that level. And you can see the low of this bar is just below the high of that bar. Probably if they placed a limit order to get out break even, they were able to get out break even. So they sell here, wanted to sell more higher, were not filled, and disappointed by how strong this rally was. They placed a limit order to get out break even, or maybe a pip or two above here, willing to take a pip or two loss. And if they did not get out with a limit order, they would get out on the reversal up. We have a wedge bull flag, 3 legs down, 1 pullback, 2 pullback, 3, and now we're reversing up with a bull IOI. Whenever you look at any chart and you're seeing pullbacks, but you see that the bears are not making money or that it's very difficult for them to make money, the bull trend is strong. If you're not long, one way to get long is to buy everywhere where you think the bears might be selling, because they are going to lose money. If they lose money, you make money. You know it's a strong bull trend, and therefore 60% chance that it's going higher, probably for some measured move up. And all through here, you look at that and say, yeah, it's a bull trend. And therefore, if you're able to say that, you are 60% certain that it's a bull trend, and therefore 60% certain that the market is going higher. Whenever you look at a bull trend, you'll look at it and say, yeah, it's a bull trend, therefore it should go higher. It never looks as good as you want it to look. We're getting bear bars, multiple reversal attempts, a wedge, but the bears are not making any money. That's a good indicator that the market is going to go higher, and you can see it went a lot higher. And if you're a trader, 60% is as good as it gets, and therefore you have to get long. Even if you're just trading very small, you need to get long, you need to buy. We're getting a lot of reversal attempts on the part of the bears. We have consecutive bear bars here and here. However, the pullbacks are small, and if you look at the next higher time frame, either a 15-minute or 30-minute chart, the pullbacks do not exist. It's simply a series of bull bars, a very strong bull trend. We're getting pullbacks, so it's a bull channel. The channel is very tight. However, it's a breakout on a higher time frame chart. The probability is still high that we're going higher, maybe slightly less likely in the channel phase than in the breakout phase, but it's still probably 60% at any point through here that we're going to go higher. Breakouts, a lot of traders just get scared. It's bull bar after bull bar. Their risk is far, and they're afraid the market could reverse deeply and quickly, and they don't buy. One of the nice things about a channel is everything happens more slowly. Instead of going straight up bar after bar after bar, it often goes sideways for 5 bars or 3 bars or 2 bars, and it gives you more time to make decisions. There's less pressure, less time pressure, and it's easier to trade. If you bought a pullback, let's say a high 2 bull flag above here, and compare that to the breakout trader who bought this close, the stop for both entries is here. It doesn't matter whether you bought this close as part of a breakout or bought above this bull bar for a high 2 bull flag, a pullback. The risk is about the same for the two. For breakout traders, 60% chance we're going up for a measured move. Once it starts to pull back, the reward usually is smaller than it was a moment ago during the breakout phase, but the math is still very good for the bulls. Once you start to get pullbacks, the trend is less strong, and therefore it's less likely to go as far. "75% of the time, the channel is going to evolve into a trading range, and that means a break below the bull trend line at some point is going to last long enough so that instead of the bull trend resuming up, the market instead goes sideways." Whenever you have a bull channel or any bull trend, 75% chance you're going to get a break below the bull trend line. Bull trend, break below the bull trend line. Bull trend, break below the bull trend line. It can do that by going sideways or down. Here, bull trend, break below the bull trend line. Here it broke below by going far down. 25% chance that instead of a bear breakout, you get a bull breakout and then an even stronger rally. When the market's in a channel, you keep getting new highs, breakouts, but usually the breakouts do not last a lot of bars. And that's because bulls take profits above prior highs, and you'll have bears selling and selling more higher above every high, betting that the breakouts will fail and that pullbacks will fall below breakout points. This is too early to sell. You look to the left and you say, well, the bears are not making money. Well, if the bears are not making money, don't be a bear. Don't sell. Don't sell until you see the bears clearly making money. You can see we go to a new high by a little bit. This high is a little bit above that high, and yet it pulls back, pulls back, pulls back. Every breakout to a new high is followed by a pullback, and there are also bars with tails on top after every breakout to a new high. So it's disappointing for the bulls, yet not so disappointing that they wait. Instead, they buy. Pair of bull bars, bad follow through. Pair of bull bars, 3 bull bars, but tail on top. 3 bull bars, big tail on top. So we're starting to get bad follow through after every bull breakout. Increases the chances that the bull trend is ending and that the market is transitioning into a trading range. A lack of particularly big bull bars. A lack of consecutive big bull bars. We have a big bull bar here, here, and here, but where is a follow-through big bull bar? Instead of getting 2 big bull bars, we're getting a bull bar and a bear bar, bull bar and a bear bar. So something is wrong with the rally. It's probably going to be a bull leg that will evolve into a trading range. Because the pullbacks are small and the channel is tight, traders trade it like a breakout. They're looking to buy for any reason. There's a big difference between trading in a breakout and trading in a tight bull channel. In a breakout, traders are buying for any reason, including at the high of the prior bar. Once we're starting to get pullbacks, a lot of the bulls sometimes buy above the high of the prior bar, but they prefer instead to buy pullbacks, like a high 1 or a high 2, high 1, high 1, high 1, here, high 3, so a wedge. In a channel, they're buying pullbacks and they're selling at the prior high, at least selling a little to take profits, partial profits, and that's why when we see a new high, we're getting a pullback. A new high, pullback. New high, pullback. That is from mostly bulls taking some profits. You have some bears selling, but as I said, most bears do not want to sell if they look to the left and see that other bears have not been able to make money selling at prior highs and scaling in higher. So not a lot of bears selling. Pullbacks mostly due to bulls taking some profits. Where do the bulls take their profits? If they feel like the range is fairly big, at this point, the market is about 50 pips up, so that's a pretty good range. They'll be looking to sell out of part of their long, either at the prior high or 5, 10, 20 pips above. So for example, no matter where they bought, for any reason, they could take partial profits at this high right here, or they could place a limit order to sell maybe 10 pips higher, and they could take their profits right here. Same thing, some bulls took partial profits here. Does not matter if they bought here, here, or anywhere, right? They're looking for a reason to take profits, and a breakout to a new high is probably going to lead to some kind of a pullback, selling out of longs at the new high, or selling 10 pips higher. Therefore, it's a good strategy. And the bears are doing the opposite. They're selling as well, but they're selling betting that the bull trend will evolve into a trading range. Here, again, as I said, bear trend instead of a trading range. Bears, they'll sell at prior highs at this high and get filled. And they'll sell at this high and get filled here. They'll sell at this high and get filled here. They'll sell at this high and get filled here. And what are you noticing? The pullbacks are not deep enough for the bears to make money, even scaling in and even using wide stops. And therefore, most bears will not sell. Most of these pullbacks are due from profit-taking bulls and not from bears attempting to create a reversal. Whenever the market is in a tight bull channel or a breakout, the first reversal attempt is going to usually be minor. The bull trend will resume. When it tries to reverse again, it will probably be minor again. Traders will buy reversal attempts, betting that instead of a reversal, the best the bears get is either a trading range or a bull flag, and the market will go higher. Again, a tight bull channel is a breakout on a higher time frame chart. When the market's in a breakout, traders should only buy, and therefore they should only buy when there's a tight bull channel. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading tight bull channels.